Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings in the first quarter of 2023, and that stock is Netflix. And we can see that over the last 12 months, Netflix's stock has done really well, returning around 96% in the same time period that the S&P 500 returned 3%. So they've returned a ton of value back to shareholders over the last 12 months. But we're going to see how in this video that actually might not be good news. So we're going to look into some of the recent news that came out surrounding Netflix, as well as their financial statements, and then finish off the video with a discounted cash flow model to figure out the intrinsic value per share for Netflix, so we can know if this is a good price to buy into Netflix from a value investing perspective. And so to start off the video, we're going to dive right into this article here that says, is it time to sell Netflix stock? They point out that some of Netflix's new initiatives have gone over well, but the company has slow growth rates and it might be valued a lot higher than many other growth companies. And so to start off, they point out that the global lockdown measures that were put in place a few years ago ended up contributing massively to an increase in their paid memberships from 182.9 million subscribers in Q1 of 2020 to 232 million in Q1 of 2023. But that growth has pretty much grounded to a near halt as the membership count grew around 4.9% in the first quarter of 2023. And that wasn't really abnormal because there was a slowdown in growth in 2022 as well. This chart right here shows their growth rates for each quarter of 2022, around 6%, 5%, 4.5%, and 4%. So it just got slower and slower. And we're going to see how in this article they talk about how it might not get better in the future. To start off, they point out that their expenses aren't really able to increase because their revenues are increasing so slowly. And even though they were responsible with their operating expenses in the first quarter of 2023, which only increased 2%, their cost of revenue increased 13.5%, which caused their operating income to fall by 18%. So even though their revenue increased slightly, they still experienced a decrease in profitability because of the fact that their cost of revenue increased a lot faster than their actual revenue growth. Also, if we see right here, these are one of their new initiatives that they introduced. This in particular just points out that they had a cost plus ad revenue system that ended up contributing more to their revenues than their standard subscription plan. And also, they saw positive results from their crackdown on password sharing in a few international markets like Canada, Spain, and New Zealand. And when this change comes to the US in the second quarter, Netflix is expecting a quick cancellation spike followed by a return to growth shortly after. But these new initiatives are only one-time factors. They don't contribute anything to growth a year from now. And so even though this year Netflix might see decent revenue growth, the company already captures a vast majority of the market, so it's possible that they won't stay at those growth levels for long. Also, right here they point out that they're currently trading at 35 times earnings, so they're a really expensive growth stock without actually having the revenue growth to show for it. And even if you utilize forward projections, the stock is only trading at 29 times earnings at the moment, so it could be potentially overvalued. And lastly, they touch on the fact that there are a lot of opportunities in the market that could be better than Netflix in terms of allocating your investment dollars. And so it might, at this point, be worth it to sell some of your Netflix stock, if not all of it, in order to capture other opportunities in the market. So interesting points they touch on in this article, and we're going to see how they play out in the coming future here. And so next I wanted to look at their financial statements. This is their income statement comparing the first quarter of 2022 to 2023. Right here they point out that their revenues grew around 3.7% from 7.8 billion to 8.1 billion. But as the article pointed out, their cost of revenues increased a lot faster than their actual revenues, and that ended up eating into their operating income, which ended up eating into their net income, their bottom line here, which shows that decreased from 1.6 billion to 1.3 billion in the first quarters of 2022 and 2023 year over year. So not really good news for Netflix here. Next, I want to look at their cash flow statement. We can see that year over year, their cash flows increased from $922 million to $2.1 billion. So they spent less in the first quarter of 2023 to capture new content for their streaming platform. And then on top of that, they also repurchased common stock of $400 million in the first quarter of 2023, compared to no repurchased common stock, just repayments of debt in the first quarter of 2022. And lastly, I want to look at their balance sheet here on page 6. We can see that as of the first quarter of 2023 compared to the fourth quarter of 2022, total assets are up from 48 billion to 49 billion. And we can see most of their business is still financed by liabilities at 27 billion, with only 21 billion of shareholders' equity, and retained earnings have increased from 17 billion to 18.4 billion. So they do have more money and cash to allocate to shareholders and then also to reinvest into the company. And so now I want to look at this discounted cash flow model to figure out the intrinsic value per share for Netflix's stock. Yahoo Finance is estimating that the company is going to grow at around 21% compounded annually for the next 5 years. They had around $1.62 billion of free cash flow in 2022. They have net debt on their balance sheet of $9 billion after subtracting their cash, and they currently have around 400 million shares outstanding. So with these metrics in mind, the intrinsic value per share is estimated to be around $74 per share right now, which compared to their current share price of $345 per share means that Netflix is definitely trading at an overvaluation based on these current growth estimates from Yahoo Finance. Then on the right hand side here, I did a competitor analysis comparing them to some of the other companies in their industry, particularly Amazon with their Amazon streaming services, and then also Disney with Disney Plus. And we can see that comparing the company's profit margins against each other, Netflix has a middling of the pack gross profit margin at 39%. Amazon's is the highest at 43%. Amazon is not profitable, so they don't have any items in the PE ratio, net profit margin, or return on assets, and they also, none of the three companies pay a dividend, so that's irrelevant on this table for now. In terms of net profit margin, Netflix is higher than Disney at 14% compared to Disney's 3%, 9% return on assets compared to Disney's 1%, and they're trading at a PE ratio of 34 times earnings compared to Disney's 53 times earnings. So compared to the other companies in their industry, from a financial ratio perspective alone, it would look like Netflix is doing a little bit better than Amazon and Disney. And then lastly, to end the video off, I wanted to look at some charts to compare them to some of the other companies we've looked at in prior videos. We can see that the top 10 companies that we've looked at over the last 20 to 30 companies that were trading at a share price compared to their intrinsic value are listed right here, and Netflix is not one of them. Netflix obviously has a share price at the moment of $345 per share, and their intrinsic value per share is $74 per share, so they're trading at like 3 to 4 times their intrinsic value, and so that's too high to get them on the share price compared to intrinsic value table. The only 4 companies we've looked at so far that are still trading at a price underneath their intrinsic value are ExxonMobil, GE, ConocoPhillips, and Google. In terms of growth rate, Netflix's estimated growth rate for the next 5 years is 21.72%. So that puts them in 5th place compared to the other companies we've looked at in the past. In terms of gross profitability and net profitability, Netflix had a gross profitability margin of 39% and 14% for net profit margin. That's not good enough to get them onto the board here. Adobe still holds the number 1 spot with 89% gross profitability and 36% for Microsoft on the net profitability table. And lastly, for stock performance over the last 5 years, Netflix returned only 7% over the last 5 years, so pretty much breaking even over the last 5 years here, even though there's been a ton of volatility with really high stock prices and also really low stock prices. But if we look on the right-hand side here, it's not good enough to get them onto the board here. Tesla is doing the best with a 700% return over the last 5 years. So based on these tables, it seems like Netflix isn't really doing that good compared to other companies that we've looked at. They're really only making it onto the growth rate table, but on all of the other tables, they aren't really matching up to their competition. In terms of the competitor analysis in their industry, they seem to be doing slightly better than Amazon and Disney in terms of profitability ratios, but that's not really saying much considering the fact that Amazon is not profitable and Disney they have profitability ratios that are in the single digits. And lastly, they, according to this discounted cash flow model, are definitely not trading below intrinsic value per share. So a lot of interesting news coming out surrounding Netflix. It looks like their company is struggling right now. They don't really have that much in the way of growth initiatives, so we'll see what happens to this company and this company's stock moving forward. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.